Today, we're going to talk about everything oil and gas investing and ultimately who should invest and who should not invest in oil and gas. Ultimately, if you are a high net worth individual or an ultra high net worth individual, oil and gas could be an advantageous thing that you should add to your diversified portfolio. Now, if you're a W 2 corporate employee, it may not be the best fit. Reason being is you want to have enough investable net worth that's liquid that ultimately is going to allow you to adequately invest in projects beyond your everyday living expenses, your annual expenses, and the debt that you might have. I have another video on this that talks about your liquid net worth, so stay tuned for that. But if you are able to invest in oil and gas with a minimum of $50,000, traditionally for most private placements, and you're able to keep that $50,000 investment through the lifespan of the project, which is traditionally is maybe like a 10 to 20 year sort of time frame, then oil and gas can be an absolutely beneficial way that you should add to your portfolio. I'll go through a number of things in this video, but there's additional information that I include specifically in the ebook, and stay tuned to learn what is in the ebook to know if it's going to be the right fit for you. Now, there's three reasons why oil and gas investing is advantageous. The first is diversification. You're able to be outside of the traditional stocks, bonds, and mutual funds. You're also out of real estate. That means that you're able to have different market exposure and also different benefits. Part of that benefit is actually the massive tax savings. So you're able to offset active income. You're also getting higher cash flow returns than you would other asset classes. Now, there's three different types of projects traditionally that you can invest in oil and gas. The first is going to be mineral rights, which are ultimately the ability to extract those minerals from the ground, and those are paid out from the operator. Obviously, these are lower risk, but there also is limited growth on them. You're traditionally getting maybe like a 10% to maybe 15% sort of annualized return, no tax benefits at all whatsoever. It's also you're reliant on the operator and ultimately can get stopped in its tracks. If an operator doesn't come or an operator stops, you're immediately losing out on that benefit. So be mindful of that. Now, if we look at producing assets, these are existing wells that ultimately are going to have steady cash flow and are going to have limited upside. Now, there's a nuance to this of something that we do at Sandstone Group that I will talk about as well. Traditional drilling operations are going to be what's called wildcatting, where you're ultimately poking a hole in the ground and there's incredibly high upside, but ultimately that means there's highest risk. You're going to get returns that are maybe 40% plus or zero, right? So keep that in mind as you learn more about oil and gas investing for the projects that you're considering. Now, the absolute best way to invest in oil and gas, again, is something that we do at Sandstone Group and Sandstone Asset Management, because we are taking the existing portfolio of wells, we are adding additional equipment and optimizing them. So we're getting the tax savings, and then we are improving the cash flow because we have those additional wells. We're also only investing in leases. Leases are imperative because there's a portfolio of wells and not just a single well. It's also beneficial to obviously invest in projects that are already producing oil, because then you have that already producing cash flow. So these are the four main reasons of why Sandstone Asset Management focuses on oil and gas investing with this type, because you're getting the most amount of upside, best cash flow, highest tax offsetting, and then ultimately the most predictable investment from you. Now, you can write off up to 100% of your investment of up to $100,000. Beyond $100,000, that 100% write-off starts to decrease, but this is still exponentially more beneficial than real estate today, and potentially even in the future if there's additional legislation that's passed to bring back bonus depreciation to a higher level. In terms of returns, at least with Sandstone Asset Management, we're seeing mainly a 15 to 30% annualized return because of how we are investing and producing these oil and gas wells. That's not always the case, so be sure that you understand the types of wells they're working with and the experience with the operator. And that ultimately is part of the common mistakes. First, it's simply investing in single wells as opposed to leases, so be sure you understand that. You're also potentially going to ignore the operator history, not just the main partner, but also the individuals within the company as well. Sometimes what happens is that an operator is in a company, has a number of decades of experience, and then leaves and starts their own company. they then are getting more junior people to come in, which ultimately means it's not the best company because they're still figuring out the kinks of it, right? You want a company that ultimately is optimized and has been doing it as an organization for ideally decades, if not a number of years, to be more comfortable with the outputs that they're expecting and anticipating from your investment. The last thing that ultimately is happening a lot with oil and gas is overlap on technology. And that's not necessarily just AI, but that's also just recognizing they're able to correlate when and how supply and demand is going to be in future prices. If you could slow down production when demand is lower and ultimately prices are lower, that gives the ability to extract more oil when prices are high at a better rate. That ultimately is going to give you a better return on investment. So if they're not able to do some of those changes and switches, it may not be the best operator. That doesn't mean don't invest. That again just mean they're not the best. Now, before you actually do an investment, you want to understand where is it located specifically, lat longs, understand the geography of the area. Again, understanding the track record of the operator and the nuances of them is so important, I had to put it twice. Now, there's also a difference between horizontal and vertical wells. Horizontal wells are going to be the most risky because ultimately they're exploratory and they can potentially get more oil and gas, but ultimately they may actually not, which means it's similar to kind of wildcatting in some aspects. Horizontal wells are simply going to be very predictable cash flowing kings. And so with that, you're going to be able to have better predictability with your investment. Both sometimes can be done within an opportunity, but ultimately it's beneficial to know if they're more horizontal or vertical, or if they're just vertical. Sandstone Asset Management specifically works with vertical wells because we know the predictability on it. And then again, as we add additional pieces to our puzzle, we give you the best investment on it. And there's other projects like this, but it's not typical by all means. And most people don't actually go into this depths because they simply don't understand. But you, being on this video, can now understand. Now, we talked a little bit about technology, but I also want to talk about AI specifically here. Now, AI doesn't need to be used, but it is beneficial to understand. This can be AI within a company in terms of operational costs and maintenance, as well as AI on predictive maintenance, which ultimately can save a company traditionally about 20 to 30% in savings based on a McKinsey study. So again, not that you have to have AI in an oil and gas company to invest, but ultimately the more AI they're using, not just from a price action lever standpoint, but also predictive maintenance, ensures that the wells are producing at the best possible rate for the most possible price as the market shifts. And this gap ultimately can be shrunk more because of the operators that are operating the best that they can. Also, not all AI is created equal. I still know some oil and gas companies who write production down with pens and paper. So keep in mind, it may not need to be AI across the entire organization, but ultimately using AI from some of the production to do predictive, again, maintenance as well as predictive pricing. Now let's dive into more of this. The best strategy ultimately is going to be investing in what's called working interests that are in leases. Here's the reason why. This is something we specifically do at Sandstone Asset Management, and the reason being is because it's the best type of oil and gas investing. I come from a background of corporate real estate and tech, and I've found nothing else like this, and it's imperative to know the differences in what is being told in the marketplace, as well as what you can actually invest in. So working interest ultimately would be owning a fractional share of the company. You'd actually get a 1099 as opposed to a K1, which has the benefits of the tax savings and how it's reported. Again, we talked about doing leases because you have a portfolio of wells as opposed to just a single well. Sometimes operators actually offer a single well as an investment, but then use that as an opportunity to then go drill additional wells, but you don't have investment opportunities with those additional wells. And so, not to say it is a bait and switch, but I have definitely seen that be done. So keep in mind of what you're actually investing in and what is being done around the wells that you are investing in. So we know there's tax savings because we're taking existing wells and improving them. That additional equipment is going to be depreciated and you're going to have that tax savings. The cash flow, as I mentioned, are traditionally going to be 15 to 30% because we have existing wells. We're making them more efficient and we're also drilling additional wells, which then gives you the opportunity for that higher cash flow percentage. Of course, with oil and gas, you're going to be diversified from your traditional assets of stocks, bonds, mutual funds, and real estate. So all these things are very important when you think about the best strategy that you could do in terms of investing in oil and gas. Not having some of these could mean it may not be an advantageous thing for you to do. But again, if you are looking to invest in oil and gas, I created an ebook which is going to go through additional details in terms of the market and how it's going to continue for the next 5 years with some industry professionals, as well as an opportunity to actually analyze an existing oil and gas opportunity and oil and gas opportunities that you can actually invest in if you are a W-2 employee who has a high income, you need to offset. If you're a high net worth or you're an ultra high net worth individual looking to offset your income, receive that cash flow, and of course, have that diversification.